Oriental Food Industry Holdings Berhad is a well-established Malaysian company involved in the manufacturing and marketing of snack food and confectionery products. Established in 1994, Mr. Song Kok Chong founded a small food processing company in Melaka, Malaysia, which later became one of Malaysia's leading snack food manufacturers. The company aims to offer high-quality, innovative, and affordable snack foods, continuously expanding product range to meet consumer preferences, ensuring safety, hygiene, and environmental standards. Offers snack food, confectionery, and instant noodle with popular brands like Jackers, Super Ring, Rota, and Zest. Tan Sri Dato Azizan bin Hussein served as the independent and executive chairman and served on various committees. Datuk Sri Son Chen Chuan, Group Managing Director and Founder, provides strategic leadership product development and oversees local and international distributor relations.
Assalamualaikum. My name is Muhammad Hakimi. We continue the presentation. History about Apollo Food Holding Berhad. Since 1953, the Apollo brand has been part of the nation's snacking story, starting from small local setup become the most beloved brand. The mission is creating joyful treat for every moment, every occasion. And their mission is to delight the world one bite at a time.
The forecast for 2025 until 2029 predicts steady revenue growth from 249.7 million to 407.3 million with a 13% compound annual growth rate. Gross profit increases from 41.2 million to 76.5 million while operating expenses rise moderately. The cash flow forecast for 2025 until 2029 shows steady operating cash inflows, consistent outflow from investing, and positive financing inflows. The business is cash generative and financially sound through 2029, demonstrating consistent profit generating and good working capital control. The company's financial position from 2025 until 2029 is expected to be stable with steady growth in asset and equity. Non-current asset will increase while current asset will increase. Equity will grow linearly while non-current liabilities will decrease. The company is well capitalized.
From 2020 to 2024, revenue grew from 174.9 million to 255.3 million and is expected to reach 258.6 million by 2029. Group profit rose to 72.9 million in 2024, which temporary decline expected in 2025, followed by recovery due to better cost efficiency. Operating income peaked in 2023 to 2024 with support from other income, but high expense may lead to be a loss in 2025 before gradual improvement. Net profit reached 54.1 million in 2024, projected to decrease in 2025, then rise to 44.3 million by 2029. Earnings per share increased from 17.81 cent in 2020 to 67.66 cent in 2024, and it forecast at 55.35 cents in 2029. Overall, the company shows strong growth with the short-term setback in 2025, followed by stable long-term prospect. Firstly, cash flow from operating activity is increased, which means more inflow of cash from the company core business operation. This indicates improved performance and stronger income generation from daily activity. Secondly, cash flow from investing activity is also increased, but in this case, it means more outflow of cash. This is because the company is spending more on investment such as purchasing asset or expanding operation, a positive sign of long-term growth. Lastly, cash flow from financing activity is decreased, indicate less inflow or even more outflow. This may result from repaying loan, reducing borrowing, or paying dividend. It shows the company is reducing its depends on its standard finance. In summary, the company expect to see higher inflow for operation, higher outflow for investment, and reduced inflow from financing, reflecting a focus on sustainable growth. So right now, the statement of financial position from 2020 to 2024 shows steady growth in the total asset, which increased from RM 2065.5 million in 2020 to RM 246.6 million in 2024. This growth is mainly supported by strong non-current assets such as property, plant and equipment, as well as investment in subsidiaries. Cash and bank balance remain high through the year, indicate strong liquidity. Equity also show a positive trend increase year by year. This reflects that company ability to return earning and maintain a solid financial position. By 2024, total equity stand at RM 243.7 million, showing that the company is financially stable and investor friendly. Liability, on the other hand, are gradually decreasing. Long-term borrowing are reduced significantly, and by the forecast period, they are almost fully paid off. This indicates effective debt management and reduced financial risk for the company. Looking at the forecast from 2025 to 2029, the financial position is expected to remain stable. Both asset and equity continue to grow moderately while liability is still low. Overall, the company is projected to maintain a strong, healthy, and sustainable financial structure moving forward.
Hi, my name is Mohammad Zahim Sharin, and today I would like to present on comprehensive analysis of the Soviet and liquidity position of two major food company in Malaysia, which is Oriental Food Industry and Apollo Food Holdings. For current ratio, the current ratio is to measure a company ability to pay off his current liability using its current asset. For Apollo's food, it show consistently very high current ratio ranging from 11.13 in 2021 to a peak of 21.86 in 2023, before slightly declining to 12.1 on 2024. For Oriental food, in contrast, maintaining its more moderate and stable ratio ranging from 3.05 and in 2020 to 3.75 in 2024. While both company maintaining current ratio will above the safe breach of 1.5 until 2.0. Apollo extremely high value may indicate underutilized current asset, potentially reducing efficiency. Oriental food ratio suggests a healthy balance between liquidation and asset usage.
Next, for the efficiency ratio between Oriental Food and Apollo Food from 2020 to 2024, starting with receivable turnover, Apollo Food show consistent improvement reaching 9.41 times in 2024, indicating stronger cash collection. Oriental, however, had negative turnover until 2024, then a big jump to 59.88, which may signal irregularity or one-off correction. Next, on average collection period, ACP, and days sales outstanding DSO, both reflect how fast customer pay. Both show a better efficiency, but Apollo pace is steadier. For inventory turnover, Oriental performed more consistently between 6 to 6.7 times, while Apollo fluctuate heavily, even showing negative turnover. On total asset turnover, both companies stay around 1 to 1.3 times, showing average efficiency in generating sales from total asset. Lastly, for account payable turnover, for Apollo was from negative 40 to negative 25 in 2023, but improved slightly in 2024. This might reflect delay payment or accounting irregularities.
For the comprehensive level ratio comparison, debt to equity ratio, total debt divided by total equity, the ratio reflect how much debt is using to finance the company equity. Apollo consistently maintained a low debt to equity ratio ranging from 0.0732 to 0.1014, including maintaining relations on debt. Oriental Food, while also low, show gradually increase from 0.092 in 2020 to 0.074 in 2024, signingly a shift towards more debt financial but still within conservation bond. For next is debt ratio. This measure the population of assets financial by debt. Apollo debt remain very low and stable between 0.0682 and 0.092, suggesting a very low level of financial risk. For Oriental Food, habits a higher debt ratio ranging from 0.1976 to 0.2175, indicating more aggressive use to ability through still within the moderate risk level. Equity ratio. The higher equity ratio significant a strong relations on shareholder equity. Apollo show an expansional high equity ratio around 0.92, indicates strong financial independence and low leverage. For Oriental Food, equity ratio hover around 0.78 to 0.80, which is healthy but reflect a more balanced mix on equity and liability comprehension on Apollo's. For financial leverage ratio, this show how much assets are supposed per unit of equity. Apollo has stable and low finance leverage ratio around 1.08, reinforcing its low leverage profit. For Oriental Food, does not report this ratio directly, but based on the available equity and asset data, its leverage is slightly higher than Apollo, aligning with a great use of liability. Next is longer term debt ratio. This ratio increase no. This ratio is reported only by Oriental Food, showing the share of long-term debt in this capital structure. The ratio increased from 0.109 in 2020 to 0.083 in 2024, indicating a cautious but upward trend in a long-term financing. Lastly, interest coverage ratio, EBIT. This ratio measures a company ability to meet interest obligation. For Oriental Food, demonstrate strong interest coverage starting at a very high 382.21 in 2020, but declining to 15.05 in 2024. Despite the drop, the company still maintain a comfortable buffer. For Apollo, does not provide these metrics, but given its minimal debt level, it's likely that interest expenses are negligible of easy manageable. In conclusion, Apollo adopt an extremely conservation capital structure with minimal debt, high equity finance, and very low financial risk. In contrast, Oriental Food employs a slightly more leveraged approach, gradually increase both short and long-term debt. By manage its obligation well, evidenced by its still strong interest coverage ratio, while both company maintain financial sound position. Apollo's strength lean towards stability and safety, while Oriental Food appears on leveraging cautiously for potential growth opportunity.
Next, for profitability ratio from 2020 to 2024, Apollo Food was more profitable than Oriental Food in almost every area. Apollo had much bigger gross profit margin, over 170%, while Oriental margin was between 50% and 31%. This means Apollo controlled costs better or had stronger pricing. For net profit margin, Oriental improved from 3.8% to 10%, but Apollo did even better, going from 8% to 31%. Apollo also used its asset more efficiently, which is written on asset increasing from 5% to 22% compared to Oriental Food, 4% to 30%. When it comes to return on equity, Apollo gave a better return to its shareholder, rising from 6% to 24%, while Oriental grew from 5% to 60%. Apollo also had a strong operating margin, rising from 37%, and its return on investment stayed high, above 200%. Overall, both companies improved, but Apollo Food showed greater and stronger and more consistent profitability.